Hey, how are you? Hope all of you are well. It's your CPA Manish here today on Friday, the 27th of January 2023. Today I got a call from one of my clients. Their question was that their son is starting with a new employment, starting with a new job from 1st of February. And as a CPA, if I had any advice for the kids. So that is what we are going to discuss today. So for our kids, I would advise three things. Number one, we should look into HSA. HSA stands for Health Savings Account. You can have a health savings account only if you have a high deductible health insurance plan. Only high deductible health insurance plan are eligible for HSA. Most of my clients do not have high deductible health insurance plan. They are not really very fond of having a high deductible health plan. But when it comes to kids, maybe because they are young, it might make sense for them to go into high deductible health insurance plan and have a low health insurance premium every month. By doing that, number one, you will be paying low premium. The kids would be paying low premium on health insurance. They don't need very profound health insurance, so to say. And number three, they will be able to contribute into health savings account. Now, if they are able to contribute into health savings account, what it does is when you make the contribution, you get a deduction for that. So when they contribute to health savings account, they get a deduction, number one. Now, when this contribution grows for a number of years, all this growth is also tax-free. So at the entry, you got a deduction, and then the growth is also tax-free. And then when you take the money out of a HSA plan, if you take the money out for eligible health expenses, then whatever money you take out, provided you spend that for eligible health related expenses, you do not have to pay tax on withdrawal also. It's not an over exaggeration. In IRS code, this kind of tool is not seen anywhere else. Usually, if you get a deduction when you contribute, then it becomes taxable when you take it out. And if you don't get a deduction today, like in Roth contributions, you don't pay taxes, you don't get deduction today, so you pay taxes today. But then when you withdraw, you do not have to pay tax. So there is tax at least on one end, at least either at the beginning, then there is no tax at the end, like in Roth, or there is no tax in the beginning, like you get a deduction, but then it is taxable at the end. HSA is the only tool that I know of in the IRC code, in the IRS code, in the Internal Revenue Code, where you get a deduction when you enter, when you contribute, the growth is also tax-free. And when you take it out and use for eligible expense, even that is not taxable. So HSA is a very, very powerful tool in that sense. So that's why HSA is recommended. Now, few things regards to HSA. Number one, if you take it out and you use it for eligible health related expense, it is not taxable. But if you take it out and do not use for eligible health related medical expenses, then number one, you will have to pay tax also at that time, and you will have to pay a 20% penalty also. So if you take money out but not use it for eligible medical expense, then you have to pay tax and you have to pay 20% penalty. But if you are at that time more than 65 years old, if you're more than 65 years old and you take money out and not use it for eligible medical health related expense, then you will have to pay tax. But because you're more than 65 years old, you will not have to pay the 20% penalty. Okay? One more thing about HSA. I usually advise my clients, if you put money into HSA, you put money in 1 year, you don't have to use it. It is not use it or lose it. You can let it invest and grow. You add money in the second year, you don't have to use it. It's not use it or lose it. Invest it and let it grow. You put in money for third year and so on and so forth. Try that you do not use the money and keep the money invested and let it grow, because the growth is tax-free. Let it grow year after year. Even if you have eligible medical expenses, even if you have eligible health-related expenses, try not to withdraw that money from the HSA as you go along, because if you save the receipts of all your eligible medical expenses, if you save receipts for all your payments that you have done for eligible health-related expense for all these years, then at the end, when you withdraw the money, let it grow tax-free. But if you withdraw the money after 15, 20, 25 years, at that time, first you can reimburse yourself for all the eligible expenses that you were paying out of your pocket for so many years. So as you go along, only put in money in the HSA, let it grow tax-free. There is no need to take the money out. There is no use it or lose it. So you don't have to take the money out year after year. Let it be invested, let it grow. You just can, if you can afford to, just pay your eligible expenses from your savings, from your personal account, and accumulate all the receipts and all the payments. And then after 15, 20, 30 years, whenever you take the money out, first reimburse yourself for all the expenses you made so many years. And then the remaining amount either can be used for eligible expense, or you will have to pay tax and penalty, or if you're more than 65 years old, you will have to pay tax, but you won't have to pay penalty. Okay, so that is how HSA works. So that's number one advice for kids. Try to do HSA contribution year after year. Now the second advice for kids is try to max into 401k plan. So if your place of work, if your employer offers a 401k plan, then try to contribute the maximum to the 401k plan. This year in 2023, the maximum employee deferral that you can do to a 401k plan is $22,500. Try to max out, if you can afford to, try to max out that $22,500. Secondly, if you are able to do 401k and your employer is offering you Roth 401k, if there is a Roth feature, it is highly recommended that you do contribute in a Roth 401k. I made videos about pension planning and I've explained what Roth is, so you might want to take a look at those videos. But in short, Roth will not give you a deduction today when you contribute, but that's okay, because in retirement, when you withdraw the money, you will not have to pay tax at that time either. And assuming that our kids are in a lower bracket today, but they will be in a higher bracket in future, it's better to do Roth so that we don't need a deduction today at a lower rate. We rather do not want to pay tax in retirement at a higher rate. Okay, so that is the second advice. The third advice for our kids is, if you can afford to do HSA and then afford to maximize the 401k and still there is a possibility of you saving some more money, then you can do what is called as a Roth IRA. Roth IRA in 2023, you will be able to put in $6,500 per year into a Roth IRA account. Again, you won't get a deduction today, but when it grows into retirement and you withdraw, you do not have to pay tax at that time. So it's a superior, much more better way of saving money for IRA. If you cannot do Roth IRA because your income is too high, then you definitely want to look into what is called as a backdoor IRA. Again, look at my videos. I've explained what is backdoor IRA in previous videos. Backdoor IRA is where you contribute to a traditional IRA today, You contribute to a non-deductible traditional IRA today, but then immediately you turn around and convert that non-deductible traditional IRA into Roth IRA. That is called backdoor. I cannot go directly because my income is too high, but I can do indirectly. It's called backdoor IRA, where I first put the money into non-deductible traditional account and then convert it into a Roth account. That is allowed even if my income is too high. The only caveat there is, if you already have IRA accounts, then there is something called as a pro rata rule which would backfire the whole thing. So if you already have money in IRA accounts, then this becomes very technical. Don't do it without consulting your accountant or CPA, but otherwise do either Roth IRA or do backdoor IRA. That is highly recommended. So for our kids, 3 advices. Try and do HSA. That you can only do if you have a high deductible health insurance plan. So you want to make sure your high deductible health insurance plan is HSA eligible, right? And in HSA we discussed how to manage that, right? The second advice is do 401k, maximize 401k, employee deferral. If possible, do Roth 401k. And third is do Roth IRA or a backdoor IRA. So that is advice for our kids. I hope that helps. Take care, and I'll see you in the next video.